Potentia Wealth brings you the Power of Wealthness podcast.
Welcome to the Power of Wealthness podcast. I'm Todd Barney, joined by my co-host Kevin Swanson. Today, we're going to do things a little bit differently. For those of you that have been longtime listeners, you know that we've been talking about topics not always market related. With this being close to the beginning of the new year, we thought with the news headlines, it was time to go through the chaos and get to what really matters. Let's address what the media is getting right, what they're getting wrong, and most importantly, how to build smart portfolios regardless of what's happening in the markets. Today, we're also excited to introduce our producer, Bill Tucker, who spent the last 3+ decades in financial reporting, and he's going to join us with some perspective and some enlightening questions. Bill, welcome to the podcast.
Hey guys, thanks, Todd. Kevin, thank you so much. I mean, I've been sitting back here behind the scenes watching. I feel like, now I'm exposed. So it's good to be with you.
The Wizard of Oz is no longer behind the curtain.
I'm no longer back here pulling the levers. No. Well, I still got to pull the levers, okay, but I like this topic a lot, guys, because there are a lot of headlines out there today that I think probably confuse investors. I mean, a sample of which is interest rates. Wow, they may stay high. They may stay high longer. They're not going to go down. There's also the headline about global conflicts, and global conflicts, as we all know, raise uncertainty. AI, a little bit in the news. AI is booming, but jobs feel less secure. Questions about valuations of AI stocks. And then this is a midterm election year. So we've got politics in the mix as well. There's a lot of things to consider. So it's going to be interesting to get your insight on these.
And I just took a little bit of correction. We've not just recently had confusion and chaos, but a lot of things have been changing for a while now. I think this is kind of the new normal.
I think you're probably right, actually. I think you're probably right.
Well, since all of us have a little gray hair, I'd say that we could look back over the courses of all of our careers, and there's always a lot going on. It just feels like so much. And from our previous guests that we talked about with behavioral finance and investor psychology and how this impacts our thoughts of what's going on today, and it all seems new, but it often rhymes with what's happened in the past. So I'm looking forward to this conversation as well.
So where do we want to go here? Do we want to talk about higher interest rates first, guys? Because from my perspective, these aren't so high, but
Let's put that in perspective. Interest rates historically, if we go back 25, 50 years, they're still low. Mm-hmm. They were extremely low coming out of 2008 and remained there for 15 years. And so most of the young investors that we're speaking to now haven't experienced rates that were at 6, 7, 8%. But it wasn't that long ago when we had 18% loans on mortgages. And so this is still a very reasonable, very workable interest rate. It just doesn't feel like it for a lot of people that haven't been there before.
Well, and I love this. I got to tell you, I'm smiling ear to ear. I've built my entire career off interest rates, bond markets, and nobody wanted to talk about it. They avoided me at every cocktail party because it's boring as hell. And here we are talking about it, question number one. And I'm just absolutely thrilled. So thank you guys for bringing this in. And you're exactly right. Rates, we look long-term, they're not that high. Question is what's going to happen? But
we're here to make bond traders and feel happy.
That's it, exactly.
Good luck with that.
No, as I tell everybody, I'm a great cure for insomnia. You want to go into duration and credit risk and all of that good stuff. But the reason I always like to start with interest rates are, and I think both of you would agree, really rates set the stage for all of the asset classes around, especially that what we used to call the risk-free rate, which becomes more of a question and what's going to be happening there. And obviously the changes at the Federal Reserve coming this year, I think are going to provide some of the impact as well. And that's where that misinformation comes from. Not to attack you, Bill, and your past, but how often did you put out a headline and you talk about it, people scan it and they move on, but they don't quite really understand the impact that goes through and the reverberations through the rest of the asset classes.
All of the time. And in fact, one of the things that I learned to say when I was actively involved in coverage of the markets and stuff, is that occasionally I would reiterate the interest rates are really basically the fundamental cost of money. And, that I figured that was the best way to sort of get at everything else, because people can understand that cost reverberate. They're like little, circles in the pool when you throw a stone into the water. Those waves go out, and they affect a lot of different things. And cost, especially cost of money, can become important. But how do you guys deal with it, given the uncertainty and everything else?
Well, first, you have to put the cost of money in perspective, because when we all hear about the Fed lowering interest rates, but that's the interest rate that the Fed loans money to banks. And that's not what we're paying on our credit cards. That's not what we're paying in mortgages. Those interest rates are determined by the market. So even though you have the Fed lowering interest rates, you may not see lower mortgages. And so as you look at it at 10, 15, 30 years out, we see that more range bound as to where it is, regardless of what happens short term. So again, we're seeing a lot of that chaos that's happening short term. We need to be focused more on the future.
Well, I'd add to that as well. I think when you look at interest rates and when you look at just fixed income overall, bonds overall, you really can separate it into two and oversimplify into two separate risks: inflation and the view of what's going to happen there, because that's going to dictate really what happens with interest rates. Inflation goes high like we saw in the last few years. The Federal Reserve raises interest rates. Why? They want to stop that access to credit. They want to stop the spending. They want to slow it down. Think of the Fed as driving the car, and they're tapping the brakes to slow the economy for a sustainable growth.
Yep.
Then you have times where, and I know we're going to talk about some other topics later, where the economy may be slowing. So how do they put the accelerator down? They start lowering interest rates, encouraging borrowing, encouraging that piece to come in. And that's one of the major factors that come in when we look at bonds. So when we're talking about those pieces of the portfolio, Bill, we're really looking and saying, okay, interest rates are unstable now. We're not sure if they're going to stay higher for longer, or will they cut? We know there's arguments for both. So let's stay a little bit shorter in terms of maturity. We'll stay within 3 to 7 years or 5 years, whatever the number is, but shorter, because that means I get my money back faster to reinvest at future rates, but also gives me a runway for that income stream, which most bond investors are looking for: stable income to come through and get that money back.
Yeah, but the shorter the maturity on the bonds, the more volatility you're going to have, because it's going to have more impact by the changing Fed rate. Where the longer the bond, the more it's market driven. And I expect to see that to be more stable. So if you're looking for stability in bonds, aren't you looking for longer maturities?
Well, and it depends on which one you're talking about. And this is why, like going back, Bill, like I talked about with the headlines, right? We have to delve down and peel that onion back. If I'm worried about the Federal Reserve moving interest rates, then Kevin, you're exactly right. I'm worried about being short term, because if they start raising interest rates right away, I'm going to suffer valuation, or the value of my bond will go down. The interest rates aren't as high as they are compared to the new interest rates from the Federal Reserve. You're also brought in with long bonds. That's more to your point, the investor, the market, inflation expectations, right? If I think interest rates, and the best way I could put it for investors, as borrowers for our mortgages, when interest rates are high, we sign on, and what's the first thing we talk about? When interest rates come down, I'm going to refinance. I'm going to get the lowest interest rate for the longest possible time. When I buy a bond as an investor, it's the exact opposite. It's the flip side of the coin. I want the highest rate for the longest amount of time. And so we really have to dissect what's the goal for the investor, and then we can help to dial in and triangulate exactly what type of portfolio we want to build for their needs, whether it's short term or longer term.
Bill, this is why this conversation is so important and confusing.
Mm-hmm.
Bonds are so much more complicated than stocks are, because you're looking at not only changing interest rates short term, but the impact that has longer term. So we talk about duration, which is the amount of influence that the changing rates have on that particular fund. So even if we see a change in the Fed funds rate, it may not affect the longer term bonds as much. And so when you're focused on the more stability and the longer maturities, you've also got to pay attention to how that's going to be impacted by what's happening short term. And so if we see the Fed lowering interest rates, that's going to be great for maybe a shorter term car loan, for some short term bonds that you could invest in. If they're going to be raising interest rates, you want to be also in the short term. So if you're looking for a mortgage, that's going to be a longer term, has less impact by what's going on with the Fed. So it's everybody pays attention to the Fed and short-term rates, but what's really happening and where you want to have your money plays a significant role in how you view what's going on in the market. That's where we play such an important role in fixed income. People say, well, I'll use my financial advisor to help me figure out how to manage the equities, but they should really be using their financial advisor to help them figure out bonds, because they're so much more complex, and it's so much more important to get that right, because that's the stable part of the portfolio you're looking for.
So how do you do that, Kevin? I mean, or Todd, whoever wants to take that one. When you're looking at the portfolio and a client calls you up and you have a conversation about bonds, how do you explain how you structure that part of their portfolio for them?
Yeah, we put Todd on the phone. He is our resident expert on bonds. As a matter of fact, we came to the conclusion with our investing team that he is the expert, probably in the Western United States on bonds, correct?
I'm going to hike up my pant leg because it's getting a little bit deep in here with that compliment. And if my career has ever taught me anything, it's once we think we know exactly how it's going to behave, it goes the exact opposite way. So I'll caveat with that. But Bill, I try to make bonds as simple as possible, not because people aren't intelligent, but because, as Kevin just highlighted, and we've been talking about now for the last 10 minutes, they're so intricate. And I think a lot of people overlook them because they see a 4 or 5% interest rate and they say, that's not that exciting. I want to have NVIDIA or whatever the stock du jour is that's going through the roof, and makes it a much better talking point when you're at a cocktail party talking about what's working well. But to your point earlier, the ripple effect that it goes through and impacts each one of those is so important. So I look at the bonds as the foundation of the account. To answer your question directly, because it was a very short question, I got into a long answer. But when we look at it, it first starts with the investor and what their goals are, and then where do bonds fit into that? And so I'll give you an example. If I'm talking to a 30-year-old high-tech or entrepreneur that's making a lot of money, what are we trying to do for them? We want their money to grow as fast as possible. So they start with a very small amount of bonds in the portfolio, frankly, if any, depending on what their financial resources are, because they need growth for that end goal, whether it's purchasing their first home, whether it's putting children through college, whether it's retiring. But they have so much time to grow. We want to have that in there, or have the equity overweight, but have the bonds in to mitigate that volatility, protect on the downside when the stock market starts to give back some of those gains we've been having. And we've had one hell of a run. The last 3 years have been great. 3 consecutive double-digit returns in the S&P 500.
Yes.
Many are arguing because interest rates were low for so long. The cost of money, back to Kevin's point, wasn't there. 2022 was a different story. Inflation skyrockets. The Federal Reserve jumps interest rates by 5 full percentage points, 500 basis points. They increase these rates, bond market sells off, stock market sells off, because now companies need to pay interest to borrow money. And so we had to be careful on what happens from there going forward. Conversely to that, now I'm dealing with somebody that's in their late 50s, early 60s, approaching retirement. Their time horizon has shrunk. Their need for their capital has changed. And what do? We increase that bond allocation to protect more on the downside, still keep them in the equities, but the bonds are now providing much more stabilization and shock absorbers to the stock market, while providing monthly income for when they retire to be able to either spend or reinvest. So it really is dependent on the investor, but the bond impact still remains the same. It's just what degree do we put it in? Anything to add, Kevin?
Just that in that complexity, we go back a year or two, and you've got really decent interest rates. I mean, investors are now being paid to put money into CDs, or their bank is actually giving them interest that's, won't keep up with inflation at that point, but historical inflation. And so putting money into banks, putting money into CDs into very safe places like that made sense for a moment. But now, as we've seen, interest rates are coming back down, and that's the shortest term. That they have the most direct connection to the Federal Reserve interest rate. So as the Fed is lowering interest rates, you're looking at CDs that you could get at 5+%, 18, 24 months ago that are sitting at 2.5-3% today. And we do expect that the Fed will probably continue to cut interest rates in 2026. So that means that's even going to go down. That means we're not making money keeping up with inflation in our bank, and we're not able to do that with CDs anymore. So we really need to look more into bond portfolios in order to get those yields, those returns, to get into the 3.5%, 4.5%.
In fact, I'd add to that, if for a takeaway for the listeners today, the first question I would ask us or your bank or whoever you have that very short-term cash, CDs, money markets, what are the rates you're getting? Because when my client conversations, we're doing reviews, clients are still anchored to that 5% number that they had a couple of years ago. And to your point, rates have come down and the outlook looks like they're going to continue to fall over the course of 2026.
Yep.
Fair point. Well, let's go from bonds to something decidedly much more exciting and confusing and troubling and certainly headline worthy, and that is the AI revolution, as it were. It's an inescapable conversation, and honestly, you had an episode where you went into discussion about AI and whether maybe the sector was overvalued or not overvalued. But I'm sure you're getting a lot of questions. How are you approaching AI?
Well, it's real. It's not a fad, and it is changing the world. So, given all of those things, we are invested in our portfolios in AI, and we are watching it cautiously because there could be pockets where we are overvalued. But that's today. That's short term. We really try to look 3 to 5 years into the future, and as we look out, we think that AI continues to play a significant role in the world, and it is changing the world. We're watching AI and robotics replacing a lot of the lower income jobs. It's displacing those people. You're not seeing that in the stock market because the people who are typically investing in the stock market aren't living paycheck to paycheck, trying to feed their families while making working at a minimum wage job that's soon going to be replaced by AI. AI also plays a role, throughout the white collar world as well. We are looking more to AI to help us manage our portfolios. We are looking to AI to help us make us more efficient in what we do and the services that we provide our clients, and it impacts our business every single day. We are using AI ongoing to help with the growth and efficiency, and I think that most companies are out there looking ways that they can tap into that as well. As that happens, that's a growth area that we are invested in.
I'd add to that as well. I think the important thing is that obviously some companies are going to win and they're going to win big and others aren't. And so what we strive for, and when we look at portfolios and interact with clients, is, you don't want to chase the trends, but you want to be able to have balance and exposure there. And that's exactly how we're approaching the AI piece. There's definitely some uncertainty. I know there's arguments over, is this reminiscent of the .com bubble that we had being here in the Valley and we've all experienced? And there are some eerie similarities to those days. However, and I'll never say it's different this time, as the three of us will laugh about, I'm sure, it's the most expensive adage on Wall Street that it's different this time. But we do have significant differences of where we stand today, economically, fundamentally, and with the companies themselves, that we didn't have in the late 90s ending in the .com crash. Are valuations stretched? Absolutely. Are we starting to see that impact? As Kevin, you just highlighted, we're using it in our own company already and we're seeing returns. Now we just need to see that large scale across the rest of the country and for larger enterprise. One of the most interesting pieces that I heard recently is that Bank of New York, in one of their calls, they were being attacked by the analysts for their AI spend. And the analyst was asking about the return on investment. And I give them credit because they fired back immediately and said, if you look at our expenses, we spend more on cybersecurity than we do on AI. So it's an investment, but it's a calculated and thoughtful approach. And that's just an indication of what we're seeing around the country.
And I'm remembering the conversation, but I can't remember the name of the analyst that you spoke with. So for those who are listening to the podcast, for the benefit of those listening to the podcast who may want to go back and check in on it, who was it that you ended up speaking with about AI and their valuations?
It was a piece of the conversation we had with Kathy Krisky from Invesco. She was talking about the more exciting parts, going back to the bonds not being exciting. She talked about AI and Bitcoin and cryptocurrencies. Exactly. Yeah. So for those of you who want to go back, Kathy Krisky and the more exciting parts of the market.
Exactly. She was the antithesis to Todd, as it were. So
I'll remember that, Bill.
Well, I'm just trying to lower the level so you don't have to pull up your pant leg quite so high, Todd. All right. This next one is, in my mind, biblically, I've got it as wars and rumors of wars. But the truth is that there's a lot of global tension. There's a lot of uncertainty about energy prices and what's going to happen with energy. This is going to be one of your more difficult areas for you to tackle and talk to investors and clients about.
It is. And and fortunately, a lot of the clients and investors don't want to talk about it. They understand that we have wars. We've always had wars. They're always for the same reason. It's money. It's power. It's control. And it's not really about drugs. It's not really about immigration. Those are excuses that are put out there to make their actions legal, and this it is really about controlling natural resources. We see that in the conversations regarding Venezuela. It's not just oil; it's that what that oil controls a lot. 50% of Venezuela's oil was exported to China. If we can control more of the natural resources that go to China, we help to slow down their war machine. We help to slow down their progress, and we are in a battle with China, with Russia, and some of the other major countries out there for global dominance. Mm-hmm. And so that's what a lot of is going on. That's what a lot of the conversations are right now. It's controlling who is going to manage the world in the future.
I think it's important to note it's, and Bill, I'm sure your reporting days, you'll remember these, but the biggest asset managers in the world, and if anybody wants one, if email us or contact us at Potentia, I'll be happy to share it with you. But there's a famous slide that says it's never been a good time to invest. Yes. And what they do is they overlay the stock market return, going back to, you pick the time frame. I've seen them as far back as 1900 or 1957 with the start of the S&P 500, whatever that starting point is. But the great thing that they did is they overlay that with Time magazine covers. And they show all of the crises. And what happens is the market goes through its ups and downs. No doubt there is volatility, but it constantly moves up and towards the right, meaning that we're innovating, we're creating wealth, we're going in the right direction. But there are these unfortunate geopolitical issues that happen. And the true cost is the cost of life and whatnot. I mean, that's by far dwarfs the economic impact. But when we look at it and we build our portfolios, we don't build our portfolios for calm markets. We build our portfolios for life. And unfortunately, life is rarely calm, as all of us know. And that's why we build these diversified portfolios. And we have some in international stocks, and we have some in bonds, and we have the growth that we've been talking about. Real life is rocky. It is choppy, and you have to be prepared for that. And most importantly, when you work with us, that's where we can help to distill through the noise and really show that the impact on your goals isn't as bad as, unfortunately, I'm going to pick on you again, Bill, the media wants you to believe.
No, it's fair. It's a fair shot. You could go ahead and pick on me. It's like,
that's why I invited you on.
For doing it for as long as I've done it, I got pretty thick skin. I don't think anything's going to quite get through, as a matter of fact. And you talk about that graph. This is really interesting because this really takes us into the next issue as well, because everybody knows it's midterm elections. There's an enormous amount of speculation about what's going to happen during those elections. If you take the graph that you talked about and lay it over wars, it's really clear that, there are wars and there's all kinds of conflict, and there's that market doing its thing. Is that graph the same for politics? When you lay them over politics, do politics have a profound effect on markets, as a matter of fact? Or do markets kind of have a way of ignoring that kind of thing and going off out their own way?
So I said that the title of that slide for the Time magazine is "It's Never a Good Time to Invest." And it's sarcastic to show that the headlines don't impact as much. Another title slide that I have used for years, and I'll give credit because it's a good friend of mine that actually drafted it. His name's Brian Levitt. He's a global strategist at Invesco. He coined the term, investors care about politics, markets don't. And I absolutely love it because it cuts right to the chase. What are we looking at? And yes, we're told every 4 years, and this is an off year, but if we're told every 4 years for the presidential election, it's the most important election of our lifetime. Democracy is at stake. Whatever headline sensationalized piece is there. And I will fully admit, on the social aspects, that is absolutely true. And it doesn't matter which side of the aisle, you believe one way, and you have to find the candidate that believes close to what you believe socially.
Yeah.
Economically, it just doesn't pan out as much. And I like to go back and really look back, and I highlight Ronald Reagan and President Obama. I think we could agree from a political standpoint, they couldn't be more opposite. Interesting enough, the S&P 500 during both of their 8-year terms had almost identical returns within a few hundred basis points, a few percentage points over 8-year terms. Innovation comes from the fundamentals and from the business and economic standpoint, not the resident of 1600 Pennsylvania Avenue. I don't think that President Obama deserves credit for Uber and technology companies booming and the iPhone. I also don't think that Ronald Reagan deserves all the credit for the innovation that happened in the 80s and the boom that we saw then. It really comes down to those individual pieces. So I think I made it pretty clear where I stand on the political influence for the long-term market, but the short-term absolutely has an impact.
Yeah, and when you look at that short-term impact, you see consistency in the markets through midterm elections as well. What really causes short-term volatility is uncertainty. And as we head into midterm elections, we're uncertain about who's going to be elected, who's going to have control, and what's going to happen afterwards. And so typically you see more volatility heading into elections, and then very consistent positive returns coming after midterm elections for the next 12 to 16 months, because we've got that certainty of where the direction we're going to go. As long as companies understand the political direction that they need to go in order to make money, they can do that. As long as they've got that consistency. It's one of the reasons that, ironically, when we have a split government, it's not all run by the Republicans or the Democrats, the markets they function the best because less happens. There's more gridlock in government and less change happens. And as there's less change, there's more opportunity for companies to continue to move forward in a stable platform. The more change they have, the harder it is for them to do that. Do they hire? Do they not? Do they spend the money on R&D? Do they not? And how you manage all of that. So politics short-term has that impact on the markets. The uncertainty creates the volatility. The certainty provides us a positive outcome.
Interesting enough, I have to add to that because this will be a key piece for a lot of people out there. You're absolutely right, Kevin, on the split government is the most supportive of good economic growth. Also to that point, a president that has a higher disapproval rating than approval rating, the market does better as well. So as I usually joke after a presidential election and looking at current administration and current approval ratings, we should be in pretty good shape that the market's going to continue to do well.
Wait, I know someone who might disagree with that.
Always in your pocket. That's good to know he's in your pocket, as a matter of fact. So that raises the big question. What do investors do? What should they do? Because there are a lot of things that are uncertain. There is a lot of craziness. There are a lot of things that make investors want to take pause and think and freeze. What should investors actually do, guys?
When I was learning to drive, I had a problem keeping my car between the lines. The lines are always moving. You've got, they go left, they go right, they're not straight. You can't just hold them in place. And even when you do, the car drifts. And And my father was going to end up with whiplash because I was constantly going back and forth between the lines. And he said, Kevin, where are you looking? And I said, well, I'm looking at the front of the car to make sure I stay between the lines. He said, quit looking at the front of the car. Start looking a block or two down and pay attention to the future. And the minute I started looking out into the future of where the car was going to be, not where it was, that's when the car started to smooth out. And I think that investors need to do the same thing. Yes, there's a lot going on in our world today, but we really need to be looking longer term in our investment strategies. We need to be looking out a block or two so that our ride becomes smoother and we don't have to deal with the things that go on. Let the professionals, let us manage the day-to-day what's happening and how to go through that. We meet on a weekly basis, our investment team. We have gotten together on weekends when we've had bank crises and to determine how it was going to impact the portfolios and what we need to change. We're there. We're making the changes. We're watching the portfolio. Our clients should remain focused on the longer term.
Bill, let me ask you a question. You're at home right now. I know it's wintertime, but in your house, do you have an umbrella?
Of course. It's in the garage, but it's here.
You have an umbrella?
Yeah.
Do you have sunscreen?
Of course.
That's exactly right. That's how we like to build the portfolios. You own an umbrella and you own sunscreen. We don't know when you're going to need each, but you're going to be happy you own them.
They're both good things to have in your possession because absolutely right. They're both things at some point, different points, you're going to use.
I will say that the umbrella doesn't have an expiration date where the sunscreen does. So how does that fit into the analogy?
You can use the umbrella for both.
Oh, okay. Good call.
But ladies and gentlemen, here we are. So thanks for having me on for this. This is an interesting conversation, and I know that a lot of your clients are looking at these markets and they're looking at the politics and they're looking at the world. And they're confused, rightfully, justifiably so confused about what to do and what to think and, where to turn to. So thank you for this conversation. I hope we brought a little bit of peace of mind to people and that they understand if they got questions, they should get in touch with y'all.
Yeah. And that's what the power of Wealthness is about. So if you've enjoyed this episode, make sure that you like and subscribe so that you don't miss the next one.
Thank you for listening to the Power of Wealthness podcast. Click the follow button to be notified when new episodes become available. Visit our website at potentiawealth.com or give us a call at 408-288-7886. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Potentia Wealth or Potentia RIA. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Potentia RIA LLC, a registered investment advisor.